Frederick, great to have you with us. What's your initial take on what we've gotten so far?
Well, I think that they're being cautious in terms of still being pretty expansionary. I think the Fed is behind the curve, and they are starting to signal that they do have to raise rates, and that's a good thing. The communication has improved in that regard. But the reality is that inflation is much higher than they anticipated. It's more permanent than they anticipated. And I think it's actually a mistake to not be preemptive at this particular stage, to say that we're not going to actually raise rates until we see the whites of our eyes, which is that we're at full employment. And that may be too late, because I think there's actually good reason to think we're already at full employment. So I do worry very much about what the Fed is doing. I don't think that it's going to be a disaster, but I think eventually they're going to have to raise rates by more than they otherwise would. And to contain this inflation is going to be higher than it otherwise would. And that's not a great outcome.
You know, we were talking with Steve Leisman, who was dissecting the statement, and there was one sentence that we were all sort of puzzling about, and it's this sentence: with inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. So it's that second prong of the dual mandate, Frederick, that's in question. You had mentioned that perhaps full employment is already reached. Have we just seen the bar get dropped a little bit in terms of the conditions being met for a rate hike? Could we possibly see rate hikes on top of a faster taper?
Oh, I think so. I think that the summary of economic projections is indicating that, in fact, they're moving to think that they have to raise rates sooner than they thought before. I think that's very clear. I think the problem here is, I mean, part of the issue here is that the Fed has a view that the Phillips curve is dead, that basically operating in a high-pressure economy is not going to create a lot of inflation. And I think that I think that's been wrong for a while. I've done research on this, where our view is that the Phillips curve is very flat, where slack doesn't affect things very much, as long as the Fed is preemptive about controlling inflation. When they lose that, then in fact the Phillips curve is going to come back again. And in fact, we're even seeing elements of that. Certainly, we're seeing it in the labor market, and we have high inflation. So I think that they're just much too optimistic on the inflation front. And I think a very dangerous view. We've seen when the Federal Reserve basically shoots for high employment and doesn't worry about the inflation ball, you get into real trouble. That's what happened in the 70s. It was the disaster of Arthur Burns. Terrible policy. It's exactly what they did. I don't think the Fed will make as bad a mistake, but I do think that they're making similar type of mistakes now of a much lesser level. I don't see a great inflation occurring like we had in the 70s. But on the other hand, I think that they're just not doing the job that they need to do.
Mm-hmm. Seeing that the dot plots indicate 2 or 3 hikes next year and 3 hikes the following, Frederick, I'm wondering if you think the Fed is embarking on a mistake here, or if this path is the right one, given the conditions in the economy right now.
So I think that there is this issue of the Omicron virus and what that might do. And that's really where the big risk is, the downside risk. But I do think that we're in a situation with very, very negative real interest rates right now. What's really relevant to your spending decisions is not what we call the nominal interest rate, just the interest rate, but the interest rate adjusted for the cost of goods that you're going to have to pay in the future. And right now, the prices of goods are rising pretty damn fast. And in fact, the short-term interest rates are basically at zero. So this is actually quite an expansionary policy, given that we have had these very positive demand shocks that I think the Fed has talked always about these supply shocks. But the reality is that we have a lot of pent-up demand. People are spending a lot. We had overly expansionary fiscal policy from the Biden administration. And in fact, when you get inflation, it's true, you don't get permanently high inflation when in fact it's purely a supply shock. But we have a big demand shock going on right now.
Yeah.
So I actually think that they are getting behind the curve. They're going to need to do more, and they're going to need to communicate that. I think that they're already starting to be mugged by reality. That inflation's a lot higher than they thought. They don't want to use the word transitory anymore. But I think that they're still too complacent on basically this idea that we can just wait until we, quote, reach full employment, have too high inflation, and then we'll start doing something. It's just too slow.